Hey everyone, if you're struggling to understand the cash flow statement, this video will make it super simple. By the end of this video, you'll understand it better than most students. A cash flow statement shows how cash moves in and out of a business. Profit is not enough. A business can be profitable but still have no cash. This report connects to other financial statements. A cash flow statement is a financial statement that shows where cash comes from and where it goes. In simple terms, cash in versus cash out. Now you might be wondering, why do we even need this? Because the income statement shows profit, but the cash flow shows actual cash. There are two accounting methods you need to know. The cash method, revenue when cash is received, expenses when cash is paid. The accrual method, revenue when earned, expenses when incurred. Most businesses use accrual. The cash flow statement has three sections. Operating activities show cash from core business. Investing activities cover asset purchases and sales. Operating activities represent the cash generated from a company's daily business operations. This includes cash received from customers for goods or services. It also covers cash paid out for salaries to employees and other business expenses. Investing activities include buying and selling long-term assets. For example, buying equipment is a cash outflow, while selling property generates a cash inflow. Financing activities are how a business gets funding. Examples include taking out loans, issuing shares of stock, and paying dividends to shareholders. Investing inflows. Selling assets like machinery or property brings cash inflow. Investing insight. Negative cash flow here is not always bad. It often means the business is growing. Financing inflows. Loans and issuing shares bring cash into the business. Financing outflows. Loan repayment and dividends reduce cash. This section importance. Here's a quick trick to remember. Operating equals business, investing equals assets, and financing equals funding. Operating means business. Investing means assets. Financing means funding. Investing means assets. There are two ways to prepare a cash flow statement. The direct method, which is easier to understand and based on actual cash, and the indirect method, which is most commonly used and starts from net profit. Methods introduction. The direct method shows actual cash received and paid. It is easy to understand but less used. The indirect method starts from net profit and is the most commonly used method. Start with net profit. This is accounting profit, not actual cash. Step 2. Add back non-cash expenses like depreciation. These reduce profit but not cash. Depreciation example. A machine loses value but no cash is paid, so we add it back. Step 3. Working capital. Adjust current assets and current liabilities. Receivables are money customers owe. If receivables increase, cash decreases. Payables mean money we owe suppliers. If payables increase, cash increases. Inventory is stock. If inventory increases, cash decreases. Prepaid expenses. Prepaid means paid in advance. It reduces cash. Accrued expenses are costs you haven't paid yet, like wages or bills. Recording them increases your liabilities on the balance sheet. This also increases your cash on the asset side. The cash will eat when you add the expense. This is the final calculation. Operating, investing, and financing are added. This gives the net increase or decrease in cash. Profit is an accounting number. Cash is real money. Link back with statement. This change must match opening and closing cash. Now you understand cash flow statement clearly. Subscribe, share, and like our channel for more simple accounting videos.